All right, in today's video, I'm going to show you why the perma bears are going to be wrong again, just like they've been wrong for 10 years now. We've seen these people waiting for the next shoe to drop. This whole entire bull market, they've been trying to call a top. And if you've been listening to these people, you've either not made much money or you've lost a lot of money trying to fight this secular bull market. I've said it many times. There's more to this than just monetary policy. Sure, monetary policy is um, part of the component, and it's certainly the part that caused this um, semi-parabolic move here. That is part of the reason we've got this big crash, along with, of course, the coronavirus and shutting down the global economy. But that's not the whole picture. This is not just being driven by monetary policy and stock buybacks and all the other complete nonsense you hear from these people. We are in a new innovation cycle. The innovation cycle from 1980 to 2000 was driven by the personal computer and the internet. There are a lot of um, amazing technological advances that are occurring during this bull market. I've said it before. Uh, Artificial intelligence is a big one. Biotech, nanotech, robotics, autonomous transportation, clean energy. Just to name a few. So there is a lot more driving this bull market than just easy monetary policy. That is a component, but it's not the main component of this bull market. And so the perma bears that are they're still stuck in the past. They're expecting a repeat of the um, crash in 2009, and that is just not going to happen. So let me give you just a brief rundown of how cycles work. Uh, there is a 4-year cycle um, in the stocks that roughly runs along with the presidential election cycle. We got, this was clearly a 4-year cycle low here in 2009. Not quite as clear, but this was a 4-year cycle low right here. Remember, this is when the Fed ended QE2 and the market was not ready to stand on its own yet. We had a very sharp move down, about 20%. And this 4-year cycle ran a little short, which is to be expected because the cycle here in 2009 ran long, almost 7 years. So you would expect a short cycle to follow a long cycle. So nothing out of the ordinary here. Now we're back to our normal timing band. 4 years later, we get our 4-year cycle low here in 2016. Again, I've gone over this many times. In real time, this kind of looked like maybe it was a 4-year cycle low. The problem was that it came way too early. And since we didn't have a long cycle right here, there was really no justification for a short cycle. So I was always a bit suspicious that this really was not a final 4-year cycle low, and that it would come in the normal timing band in early 2020. And lo and behold, that is exactly what has happened. So you're going to hear all kinds of analysts telling you that this is a bear market rally, and the fact is that it just is not a bear market rally. Um, the the pattern that would have to play out for this to turn into a long-term, as in year and a half, 2-year bear market, we would have to rally for a considerable period of time here, like anywhere from 6 months to a year, and then roll over. That would be a left translated 4-year cycle. Kind of the opposite of what we've got here. You can see this 4-year cycle, it rallied for, almost, well, it did. It rallied for 4 years. So this is an extremely right translated 4-year cycle. In order for a bear market to start, and let me widen the chart so you can see this. All right, so generally how a longer term bear market starts is the 4-year cycle will left translate. That's what we've got right here. So this was our 4-year cycle low, the long-term capital management crisis, and we rallied. We got our bubble in the NASDAQ. This was the top of the long-term secular bull market that started in 1980. And you can see this 4-year cycle topped um, left translated. And by that, it means it topped in about less than 2 years. And then we had a long period of time where the market was um, moving down into that 4-year cycle low. This is generally how a long-term bear market will start. It'll start as a left translated 4-year cycle. This was a bit of an anomaly here. I think the market extended further than it would have naturally. We had a lot of interest rate cuts and Fed policy to keep this market on life support longer than it should have, created the housing bubble, and then of course that when it blew up, that started the next bear market, long-term bear market. But generally speaking, secular bear markets should start as a left translated 4-year cycle. So the odds are very much against this starting as a secular bear market. For that to begin, we would probably, like I said, we're probably going to have to rally for 6 months to a year and then roll over, and then we would have 3 years moving down into the next 4-year cycle low. That would be the pattern that would play out if this was a long-term secular bear market. And most analysts, they don't understand cycles or they don't know about cycles at all. So they make this mistake. They see this vicious move down and they just assume that we've started a long-term bear market, and that's just not the case. We're in the timing band for a 4-year cycle low, and that's what we are putting in right now. All right, so moving on to a weekly chart and a little bit more of a short-term picture here. We've got a bullish engulfing candle here, and this was week 41. Our last confirmed intermediate cycle low is right here. So this is a very stretched intermediate cycle. We haven't actually completed a weekly swing yet. We'll need to move above, I believe this is 2637 on the S&P. We'll need to move above that to complete the weekly swing. That will also break the intermediate downtrend line. I'll show you that in a minute. There are, it's starting to become significant, well, I'll say compelling news that hydroxychloroquine, Z-Pak, and zinc is an effective treatment for the coronavirus. If caught early, the odds of somebody dying almost go to zero, and the odds of even having to go into the hospital and be intubated shrink drastically. So if we want to prevent our healthcare system from being swamped, like I said, the evidence is pretty compelling that we have a treatment for it. Now we just have to cut through the bureaucratic red tape and start implementing it. We've got a few Democratic governors that are trying to block the process. I think public opinion will probably overwhelm those partisan policies, and this will be implemented here soon. So while everybody else is predicting another leg down, secular bear market, I'm going to go out on a limb and say the odds are increasing. The quicker that we can implement this drug cocktail and get control of the coronavirus, the better the odds become that this turns into a V-shaped recovery. All right, so converting to the daily chart, this is what I'm watching here. This is the intermediate downtrend line. The first confirmation that an intermediate bottom has been completed is a break of this intermediate trend line and also a weekly swing low. We've already broken this trend line in the NASDAQ 100 and also the semiconductor stocks, as I've been pointing out for way over a year. The semis are the leading sector of this bull market. They're going to be the big beneficiary as artificial intelligence is integrated into human society. So that's one of the sectors you need to keep close eye on. They should continue to lead, and they will lead during the second phase of this bull market. Right now, I'm just waiting for this intermediate trend line to be broken and for a weekly swing to be completed. That'll be the confirmation that this was indeed an intermediate cycle low, and almost certainly a 4-year cycle low as well. Um, if we get a strong push through this, uh, something that takes us above 2,700 pretty quickly, like by the end of the week, um, especially with the employment report coming this weekend, which obviously is going to be very bad. And we had just mind-bogglingly terrible numbers on Thursday's um, unemployment claims, and the market rallied. That should tell you something. The perma bears, are ignoring the fact that the market is rallying on bad news. So as of right now, this is already shaping up to be a V-shaped recovery. We'll just have to see if it continues this week and if we slice through this intermediate trend line. Um, if so, then the odds go up significantly that this is a V-shaped rally, and that the drug cocktail will be implemented, and we will get control of the virus, and the world will return to normal fairly quickly. So all in all, I've given you a blueprint of the techniques that I use to accurately predict where the market is going, to uh, accurately inform you that this is not a secular bull bear market. Um, if it is, we're still going to have a 6 month to 1 year rally before we roll over and start a secular bear market. But I just don't think that there's really much chance of that. We're still early in the innovation cycle, so this, in my opinion, this is just no different than the crash in '87, and that crash still had 13 years to go in the secular bull market, and I think we've got 10 to 15 years still left in this secular bull market as well. And if you listen to the perma bears, I can almost guarantee you that 6 months from now, I'm going to be saying the same thing I've been saying for the last 5 years, when these people predict, Armageddon, the end of the world, another secular bear market. We're going to be laughing at them again because they will continue to be wrong, just like they've been wrong for the last 10 years.